Well, let's talk a little bit about the inscrutable central banks out there. Amongst the G10, they work very similarly, and this is an important discussion to have because not only do we get a lot of questions about this and the impact that they have on the forex, but this week we've got 4 central banks that are coming out with their new rate targets, or their primary rate targets, which the FOMC target rate, the RBA is coming up here in just a day. So we're going to see those happen, and we're going to see the Bank of England, the European Central Bank. And one of the questions that we get all the time is, well, how exactly do they impact the forex? How do they manage these interest rates? Well, how does this really work? And you can dig into a lot of the nitty-gritties of how they actually do this, but it's really quite easy and simple to simplify. And to get a real good grasp on how, in fact, does this impact one of the primary drivers of exchange rates, which is capital flows. So if you remember, there's a few primary drivers of interest rates. Capital flows, so that's the flow of investment around the world. So who's offering higher yield investments? That's going to drive demand for that particular currency. Number 2 is trade flows, which there is obviously some bleed over here into trade flows, but primarily we're concerned about capital flows. The third one, which I mention usually, is cross-border acquisitions of property, plant, and equipment. It's compared to the first 2, it's very, very small. So those cross-border transactions are typically not a big deal compared to capital flow or trade flow. And capital flow is one of the big reasons why we're so concerned about central banks. Now, what is this? What are they doing? Well, let's take the FOMC, for example, or the RBA. One of their primary tools to achieve their objectives, which are to manage growth stability, currency stability, and, of course, employment, is typically the shared objectives that most central banks have. And one of the ways in which they do this is they modify interest rates, or their target rate. In fact, specifically, they manage the rate that banks will charge each other. So imagine these are all our little banks here. And these banks are charging each other interest rates on borrowed deposits. So when they need to borrow money to meet reserve requirements overnight, they charge each other a certain bank rate. And it's fairly low. This is the target Fed funds rate, by the way. In the US, that's what it's called. Now, it's a target, which means that whatever the Fed funds rate is set at, so let's say it's 2%, it's not going to be 2% on a given day. They're not bound to charge each other that interest rate on a given day. The Fed has to kind of manage this. They manipulate this rate. And the way that they do that, the Fed, the Reserve Bank of Australia, etc., the way that they do that is they buy and sell debt. So what that means is we've got this transaction flow of debt between the central bank and these little banks. So when they go out and they buy debt during the day from these banks, what are they really doing? They're pushing money. So when they buy debt, they're pushing money into the system. They're inflating. Now, what happens is then these banks they're flush with cash, and they want to loan it out. They don't want to hold a bunch of cash, so they want to loan that out. It's adjusted their reserves, etc. And the problem is they all are flush with cash. So in order to loan it out and be competitive, they have to lower their interest rate that they're charging each other. Well, if that interest rate becomes too low or too far below the target rate, then the Fed will want to buy debt. Or, I'm sorry, sell debt. So they'll be selling debt, which has the opposite effect. It actually pulls money out of the system. So when money becomes a little bit more scarce, interest rates, or that target rate, starts to rise, that's the desired effect that they want. Now, every day they're going to manage this a little bit differently. And here's a little secret, by the way. They don't do this very much. Even in good market conditions, typically central banks are pushing or inflating money into the system. Now, this is important to understand. It's not a political argument or anything like that, but typically central banks are pushing money or inflating. And what they're trying to do is they're trying to manage that. It's just the rate at which they're pushing. How fast are they pushing money into the system? So if they're trying to raise the rate, they may push money into the system a little slower than when they're trying to lower the rate, when they will push money into the system and inflate very quickly, which has the effect of lowering interest rates. Of course, in a perfect economic world, we have to assume that these things are true. And largely, it is reasonably effective, or at least as effective a system as anybody has come up with so far. Now the problem is that most of these central banks are operating with some kind of a target, they'll look at not just the interest rate target, but they'll also contrast that with an inflation target, because inflation is a risk to one of the three objectives, which is to manage growth. Inflation can be a serious risk to growth, so they try to manage that and to gauge how well are they doing their job as far as economic stability goes with how well are they able to meet an inflation rate target. Well, let's use a case study, for example. A lot of analysts are I think the majority of analysts right now are biased toward the side of no change in the RBA target rate. So the Reserve Bank of Australia is going to leave rates the same way that they are now. But there are some little bubbles of opinion out there saying, no, they may actually surprise the market and lower rates. Well, lower rates, in order to do that, what do you have to do? You have to inflate. Well, what's the RBA's target rate? Well, the RBA has a target rate here. They want inflation to be around 2 to 3%. But lately, it's been between 4 to 5%. So this is this is one of these situations where their hands are tied a little bit with both their inflation target is off, while they probably would like to lower rates a little bit to spur some growth. But in order to lower rates, they have to inflate, and they're already over their target right now. So it puts these central banks in this weird tug of war. It's never a straightforward answer. But if I were looking at the market today and trying to understand, well, what are the probabilities? What's most likely to happen? I would have to say that I agree with the majority of analysts that they're not going to raise rates because the risk of inflation or inflating too much and the risk that that plays to growth is going to be is more extreme than the risks to growth from higher interest rates. So it's this really delicate balance. One of the best ways to try to internalize this information is to read the documentation that's available about the way that they manage monetary policy from the central banks themselves. So sit down, pay some attention to what's going on there, because it'll give you some insight into how do capital flows really work, and how can I use them to start to forecast currency pairs and to try to identify which currency pairs are going to be most sensitive to a change in interest rates out there. So we'll be back with a follow-up discussion following the interest rate announcements tomorrow from both the FOMC, so the US Fed, as well as the Reserve Bank of Australia. And we'll start to backtrack through this thought process. What did they do? Now how can we take that information and start to infer market direction in the forecast, in the forex?